Okay, so here we go. Again, this is for lack of a better term, a lecture. But please, if you have questions, like, do not hesitate to interrupt. Like, don't, and I mean, you can do it in the chat if you don't feel comfortable just breaking in over the top of me. But if you're looking for a clarifying question, I will not be offended if you just say, hey, what's this or what's that. So, but as much as I hate PowerPoint, I don't know a better way to cover a bunch of information in a relatively short amount of time. So, all right, so we're studying accounting, and the reason it's called accounting is because it has accounts, okay? And so an account is just a record of an increase or a decrease of a specific type of either an asset, a liability, an equity, a revenue, or an expense. And I would put, they don't have it on there, but I would also add, why am I drawing a blank on the term? When your stock pays out a portion to the owners, dividends. So they're included as a type of account as well. And then the general ledger is a record of all the accounts that we use by the company. So these are just definitional terms that you'll kind of need as we go forward. So the first type of account, and this will be a review, I think we touched on it already in chapter 1, are asset accounts. And just remember that an asset is in essence something that a company or a business or an individual can own. The most common assets are cash, land, buildings, equipment, supplies, all those sorts of things. And probably the ones that are a little more confusing are the ones over here. So the accounts receivable, notes receivable, and prepaid accounts. Accounts receivable is money that's owed to you by your customers. It usually arises from sort of a informal relationship. So when I say to a customer, hey, you have 30 days to pay me, as soon as I deliver the goods to them and they owe me money, that creates an asset for me called accounts receivable. Notes receivable is similar. Someone owes you money, but instead of it being informal, it's more like written up with terms like who's going to pay whom and how much and what the interest rate's going to be and what date everything's due. And so just the difference between accounts receivable is it's usually short-term and informal, and notes receivable is usually long-term and more formal. And finally, a prepaid account. This is an asset that arises when we prepay for some good or service in the future. So for example, I own a rental storage business. And when people pay me in advance, so let's say they pay me for a whole year's rent, that creates an asset for them called prepaid rent. Now they either have the use of my facility for the next year because they've already paid for it, or I would need to give them their money back. So just common things that we prepay are rent, insurance. A lot of people pay for their car insurance 6 months at a time, and so they're prepaying for it. So those are the asset accounts. Liabilities are debts that a business owes. So accounts payable, notes payable, what are called accrued liabilities and unearned revenues. So accounts payable are kind of the opposite of accounts receivable. So accounts payable are when I buy something from a supplier and they tell me I can pay them in 30 days. I owe them money. And so that's an account payable. And a note payable is when I owe somebody money on a more formal, drawn up note that has terms of payment on it. So when we buy a building, we're going to do a mortgage, which is a form of note payable, or when we buy a car or a piece of equipment. Unearned revenue is money that I have received in advance. So kind of my example with my storage building a minute ago, when the customer pays me in advance, to the customer, that's a prepaid asset. They have the right to the rent for the next year or 6 months, whatever they paid for. To me, the business, when someone pays me in advance, I have what's called an unearned revenue. My money went up, my cash account went up, but I haven't yet delivered the goods or services. I'm going to do that over the next year. So in the meantime, I owe them. I owe the customer who paid me in advance those services. And then accrued liabilities are those debts that sort of arise just as in our normal course of business. The most common ones would be something like, as my employees work, I owe them for the hours they work, but I don't usually pay them until payday. So I have this accrued liability of payroll up until I actually pay them. Tia, I see you have a question. I can't hear you. Are you muted maybe, or?
Can you hear me?
Yes, now I hear you.
Okay. I'm just concerned or wondering about the unearned revenue. If monthly, does that then go down because you are delivering on that goods if they prepay for 6 months or a year?
Absolutely, yeah. So what we do is at the end of each month, we do what's called an adjusting entry to recognize that we've earned a portion of that revenue, and then our liability is dropping each month until we've earned it all. You're ahead a whole chapter, Tia, so good. That's adjusting entries come later. They're the bane of everyone's existence for a little while. But equity accounts. So equity is a little weird because equity represents the amount of the business that the owners have claim upon, that the owners actually own. If you think about it, the fundamental accounting equation that we learned, assets equal liabilities plus stockholder equity, that means that assets minus liabilities equal equity. So what the business owns minus any debts is what's left over for the owners, and that's the equity. And so equity comes in one of two ways. We either buy it by putting money into the business, that's called common stock, or the business earns it. And so that's why revenues will increase our equity, but expenses and dividends will decrease our equity. The difference between revenues, expenses, and dividends is what's called retained earnings. That's earnings that the business has made that it has not paid out in the form of either expenses or dividends, which is just paying out a share of those profits to the owners. So those are our account types right there. If you know that, you know a lot more about accounting than most people anywhere. So good job. See, you already know a bunch. All right, so there's our accounting equation, assets equal liabilities plus equity. And then equity is further broken down into common stock minus dividends plus revenues minus expenses. So that just shows it all as a single sort of picture. They call them exhibits. And this is in the book too. So if you wanted to look at it again, it just sort of summarizes everything there together. All right, so now we're into debits and credits and double entry accounting. So I think people often get sort of flustered by the concept of debits and credits because we've all grown up, not all of us, but most of us have grown up with banking. And so we've had bank accounts and we think, okay, so a debit is we tend to think of a debit as a bad thing because it's money coming out of our account, and a credit as a good thing because it's money going into our account. So we almost place these predicates of value on the terms debit and credit. And what we have to do is sort of forget that and just say that all that debit means in an accounting sense is that an entry that occurs on the left side of a T account. And all that credit means is an entry that occurs on the right side of a T account. What I have on the screen here is a T account. So you have the name of the title, and then these lines that kind of look like a big broad T. Debit entries occur on the left, credit entries occur on the right. The reason we can't put a value to it is that some accounts will increase with a debit entry and others will decrease with a debit entry. So it doesn't necessarily mean good or bad or increase or decrease. It just means left or right. Think of it like port and starboard, right? It's just left and right. They're directional terms, not terms of value or other meaning. So the reason we call double entry accounting is because every time we make a transaction, we have to have debit entries and credit entries, and they have to balance. So the debits have to equal the credits. So we can see here that assets are increased with a debit and decreased with a credit. But liabilities and equity are the opposite. So liabilities and equity are increased with a credit and decreased with a debit. You'll see on here, some of these sides are labeled the normal side, okay? All that means is we would expect accounts to have a balance that is on the positive side, the side that increases that account. So assets, normal balance is on the debit side. Liabilities and equity accounts, normal balance is on the credit side. When people say, is there a magic to memorizing this? And the answer is sort of, like you just have to memorize it. For me though, since I know that assets are the opposite of liabilities and equity because they're on the opposite side of an equal sign, if I can remember that assets increase with a debit and decrease with a credit, I can remember liabilities and equity are the opposite. So I like memorize one and get all three. That's how my brain works, but that may not work for you. So let me show you, and also let me show you an expanded view of this that includes these other accounts. So there's our assets, increase with a debit, decrease with a credit, have a normal balance on the debit side. Liabilities, increase with a credit, decrease with a debit, normal balance on the credit side. So now when we have these equity accounts, we have to remember that the ones that increase equity, so common stock and revenues, they're going to behave like equity accounts behave, where they increase on the credit and decrease on the debit. But the ones that decrease equity, dividends and expenses, they're going to behave the opposite of those. So if this seems like a lot, don't worry. I'm going to try to take you through several. That's part of why this slideshow is kind of long, is I'm going to take you through several examples of debit credit journal entries to show you how it works and talk through the process of it. So really at some point you just have to memorize this and then build that into a working relationship with these rules of debits and credits. So to find the balance of a T account, so recognize that this is our cash account, and you'll see it has debits of 30,000, 4,200, 1,900, and all of these credits over here. In order to find the balance of the account, what we do is we add up both sides. So this has a total of 36,100 on the debit side and a total of 31,300 on the credit side. Then we subtract the smaller side from the larger side, leaving a balance on that larger side of 4,800. And so if I was talking accountant talk to you, I would say our cash account has a debit balance of 4,800. That's another way of saying our cash account is a positive 4,800. We don't have negative cash, right? We have 4,800 in our cash account. So that's the process for finding the balance of an account. Okay, so this looks really overwhelming with all these red arrows going all over the place. But this is just what a journal entry looks like. You've actually already been, I guess, exposed to journal entries because you had to do some of them in the Chapter 11 work. So journal entries are always written with the debit entry first and the credit entry second. Sometimes there's a note down here. And so what helps me is to sort of go through and translate what's happening in an entry. So we see A is the transaction date, B is the title of the account in the debit column and the amount of it. And then C is the title of the account and the credit and the amount. Then D is an explanation of the transaction. So even if I didn't have this explanation, I would look at this and say, okay, cash was debited, which means, and it was an asset account, which means it increased then by 30,000, and common stock was credited. It's an equity account, which means that the credit is an increase by 30,000. So what must have happened here is some owners put $30,000 into the company in exchange for stock in the company. On the second one, I have supplies being debited and cash being credited. So I would go through this process of saying supplies are assets. And so a debit entry to supplies would mean supplies increased by 2,500. Cash is an asset, and a credit to an asset account means it decreased. So someone must have purchased supplies for cash. In other words, it helps my brain to sort of translate a journal entry into standard English, if that makes any sense. So sometimes instead of a T account, you'll see something that looks like this. This is a balance column account. It actually shows the same information as the T account, but it's a little confusing the first time you see it. Just has a date, if there's any explanation for the transaction, which these ones don't have one. And then it shows that the cash account was debited 30,000, and then it carries the balance over to this final column. Then on December 2nd, it was credited 2,500. So the new balance of that account is 27,500, or 30,000 minus the 2,500. Then on the 3rd, it was credited another 26,000, and a new balance is calculated. Then on the 10th, it was debited 4,200, and a new balance is calculated. This balance column, since it doesn't have a debit and a credit side, is always going to be assumed to be the balance on the normal side. So because cash is an asset, we're saying this has a cash account has a debit balance of 5,700 at the end of this period of transactions. All right, so let's get into some examples. I think that will help the most. All right. So the book here highlights a 4-step process for processing transactions. Number 1 is to identify the transactions. Number 2 is to analyze the transaction using the accounting equation. Analyze means ask yourself what accounts are impacted and what's happening with them. And then we record the journal entry, and then we post the entry to the ledger. And by ledger, I mean this balance column account or the T account. The ledger is the part of the account where we get to keep track of the overall balance of each account. So recognize that these journal entries we do chronologically. Each time a transaction happens, we do a journal entry for it, and then we post it to what's called the ledger, which I'll show you in the examples, to find the balances of the accounts. All right, so here's our first transaction. Fast Forward, the name of the company, receives $30,000 cash from Chaz or Chase or something. We'll call him Chaz. It sounds pretty hip. Chaz Taylor in exchange for common stock. So what I have to do is analyze and say, okay, what's happening here? Cash is going up, and cash is an asset, and common stock is going up, and common stock is an equity. And then it says record. What I would say is apply the rules as I've learned them. And so since cash is going up and it's an asset, that's going to be a debit to cash. And since common stock is going up and that's an equity account, that's going to be a credit to common stock. So there's my journal entry: debit cash, credit common stock. And then step 4 is I post it to the ledger, which is, in this case, they're using T accounts, just to show us the balance of each of those accounts. So there's the first transaction. Second transaction, we purchase supplies for cash. So again, what's happening? My cash is going down and my supplies is going up. So supplies is an asset and it's increasing, so I'll debit supplies. And cash is an asset and it's decreasing, so I'll credit cash. Then I will post those over to their T accounts. We can see now that supplies, which didn't have any balance, now has a debit balance of 2,500. Cash, we'd already made one entry on the debit side. If we were to calculate it right now, we would say this account has a debit balance of 27,500 because that is a debit of 30,000 and a credit of 2,500. But we usually don't do those, tally them up until we're done making all of our entries. All right, transaction number 3, they purchase equipment for cash. So now I have equipment going up, cash going down. Equipment is an asset, so I'm going to debit it to increase that account. And cash is an asset, so I'm going to credit it to decrease that account. And then I'll post those over to my ledger or to my T accounts. Transaction 4, we purchase supplies on credit. Whenever it says on credit, that's a secret accounting word, meaning we don't pay cash, okay? That we're going to be creating a payable account. Also, anytime you see payable in an account name, that's a secret accounting word that means it's a liability, okay? So in this case, I have supplies, an asset increasing, that'll be my debit, and then accounts payable, a liability also increasing. Right, this is confusing because sometimes people think, is that increasing or decreasing? So it's increasing because accounts payable, we owe more. We have more debt now than we had before the transaction. So our liability increases with a credit. So there's our entry: debit supplies, credit accounts payable, and then post it over to our ledger. Provide services for cash. So when we earn money by doing what we services, we call that revenue. And so here we have our cash increasing. That's an asset, so we'll debit cash. And we have a revenue increasing, and revenue is an equity account. And so we increase that with a credit. When we pay expenses in cash, we have our cash going down and our expense going up. And so remember that expenses are equity accounts, but they reduce equity. So expenses, when they increase, we record them on the debit side. So we're going to debit rent expense and decrease or credit cash. So you should recognize by now that every time we do a journal entry, the debits and credits balance, meaning we have the same amount of money being debited and credited. Also recognize that this one right here is a very common transaction. Think about how businesses run. You're going to be debiting expenses and crediting cash all the time. That's just a normal thing. In your own personal bank accounts, you do a lot of buying things for cash, right? So if you were recording that, it would be a debit to the expense account and a credit to the cash account. Which leads us to the question of, why do banks say that it's a credit when money gets added to your account? If each time we deal with a credit here, it's the asset going down. And the answer is because they're speaking from their own standpoint. So anytime you put money into your bank account, what you're technically doing is you're loaning the bank your money. And they owe that money back to you on demand whenever you call for it, if it's in a checking account. And so that's why they call it a credit, because they're crediting their liability account, probably called something like customer deposits or something like that. So recognize that that's what's happening, and that's why we're all sometimes backward on the whole concept of credit and debit. All right, transaction 7, we pay an expense in cash. So we pay our salaries of $700. Again, our expenses are going up, so that's going to be a debit. And our cash is going down. That's an asset, so that's going to be a credit to cash. Provide consulting and rental services on credit. So now it looks like, let's see, we provide consulting services of $1,600, and we rent our facilities for $300. The customers bill $1,900 for the services. So since we're doing it on credit, it means the customer is not paying us in cash. Instead, our asset accounts receivable, money owed to us from the customer, is increasing. And so we debit accounts receivable for $1,900, and then we credit consulting revenue and credit for $1,600 and rental revenue for $300. This kind of entry right here, I think it's the first one we've seen, is called a compound entry, because it has more than just one debit and one credit. This one has to have one debit and two credit entries, but both sides still balance, right? So we still have $1,900 in total debits and credits. Receipt of cash from accounts receivable. So this is where our customer now pays us for the money they owed us. And so in this case, we have cash going up, an asset increasing is done with a debit, and accounts receivable, an asset decreasing, and that's a credit. So you'll see over here on our balances, we're starting to get quite a few transactions piled up in our cash account. Our accounts receivable just had the debit of $1,900 from entry number 8, and now the credit of $1,900 from entry 9. And so accounts receivable at this point has a balance of 0, right? We're not owed any more money. And so that happens a lot. Customer owes you money, then you collect it. That's normal business. I told you there was a bunch of examples. So here we get a partial payment of accounts payable. So here's someone, we owe money to someone, but we're not going to pay them everything we owe. We're just going to make a payment on it. So we pay Caltech Supply $900 cash toward the payable from transaction 4. So we're going to have our accounts payable. That's a liability account. going down because we're paying off some of that debt. So liabilities decrease with a debit. And then we're going to have cash going down. That's an asset, and it will decrease with a credit. So our journal entry would be to debit accounts payable, credit cash. A few more here. We're almost done. We pay a cash dividend. Remember, a dividend is paying a share of our earnings out to the owners. So when we pay a cash dividend, our cash goes down and our dividends go up. So dividends increase with a debit, and then cash decreases with a credit. Here we receive some cash for future services. So it says we receive $3,000 in advance of providing consulting services to a customer. So our cash will go up, but we haven't earned it yet, so we can't record it as revenue. Instead, we'll list it as an unearned revenue, meaning we received money in advance of doing the work. So that's a liability, right? We owe the customers that service. So we'll debit cash to increase the cash, and then we'll credit the liability unearned consulting revenue to show that we owe that money or that service to the customer. And then paying cash for future insurance coverage. So we pay $2,400 for a 24-month insurance policy. So again, our cash will go down because we're paying out cash. And then our prepaid insurance, which is an asset, will go up. So we'll debit prepaid insurance and credit cash. All right. Oh, there's another one. I thought there was only 13. That'd be bad luck. So here we go. We purchase supplies for cash. We pay $120 for supplies. So again, our cash goes down, our supplies go up. They're both assets. So we debit supplies and credit cash. Oh, there's even more. Believe it or not, I made these slides today, so I should know how many. My brain sometimes has these moments more and more. So here we pay expenses for cash. Again, our expense is going to be debited, and our cash account will be credited. Another expense for cash, we have salaries being debited, cash credited. So recognize this pattern. Every time we pay an expense in cash, which is a very common transaction, we're going to debit the expense account and credit the cash account. All right. So here's a summary now of our ledger. Remember the journal entries that we were just looking at are chronological entries. Each time a transaction occurs, we create one of these journal entries with a debit and a credit of the appropriate accounts. Then we record it over or post it to the ledger. And then at the end of the period, we have this ledger, and we can find balances by adding up both sides, subtracting the smaller side from the larger side to find a balance for the account. So here we can see our assets. Cash has a balance of $4,275, accounts receivable 0, supplies $9,720, prepaid insurance, equipment, our liabilities, our accounts payable and our unearned revenue, and our equity, common stock, dividends, consulting revenue, rent revenue, and then expenses. Again, you'll notice that the common stock and the revenue accounts have balances on the credit side, because that's the side that increases those equities. And then these accounts that reduce our equity, dividends and expenses, will have balances on the debit side. All right, so once we have that, so what we do, even in real life, okay, is we do these journal entries throughout the month, and then at the end of the month, we tally up our ledger to find the balances, and then we create something called a trial balance. And a trial balance just shows all of our accounts and then the balance of each account. And you'll notice that the debits, which will be our asset accounts, our dividends and our expense accounts, should equal our credits, which will be our liability and equity accounts and our revenue accounts. So that's a trial balance. If your trial balance doesn't balance, then something's off. So it's kind of nice. It's a self-check. It kind of stinks when it happens, though, because you'd really like to be done with it. Usually by the time you get all of those journal entries, post it to the ledger, find the balances of the ledgers, and then put it in here. If it doesn't balance, it's a little frustrating at times. Anyway, so once we have the trial balance, we are prepared to calculate or create our financial statements. Again, the financial statements were introduced to you before, but now we are ready to create them. So the first one we'll create is called the income statement. And the income statement summarizes our revenues and expenses. So you can see here that we had revenues from consulting, from rent. So our total revenue was $6,100. And then we had expenses, salaries, rent, utilities. So our revenues minus our expenses is our net income. So that's the income statement. You'll notice dividends isn't on here. Neither are any of the other accounts like assets, liabilities, or common stock or dividends. So the next thing is what's called a statement of retained earnings down here at the bottom. So there's still the income statement up top, and then now we've added the statement of retained earnings down at the bottom. And you can see the retained earnings statement works this way. It starts with what our retained earnings were at the beginning of the period. So the retained earnings were 0. It's a brand new company. There were no earnings for them to retain. Then we add the net income, which we calculated up here on the income statement, which is revenue minus expenses. We subtract out any dividends, and then that gives us our retained earnings at the end of the period. So retained earnings is really just the net income or profit the company earns minus any dividends that it pays out. And then we're ready to prepare our balance sheet. So our balance sheet summarizes our assets, our liabilities, and our equity. And we know that our assets have to equal our liabilities plus our equity. That's the basic fundamental accounting rule. So it has our assets, cash, supplies, prepaid insurance, and equipment. Then our liabilities, accounts payable, and then unearned consulting revenue. And then our equity, our common stock, and our retained earnings. So recognize that we pulled retained earnings off of the statement of retained earnings. And in order to calculate our retained earnings, we had to have net income, which we pulled off of our income statement. So we have to create them in that order: income statement, then the statement of retained earnings, then the balance sheet. The good news is in real life accounting, pretty much I just enter my journal entries throughout the month, and then at the end of the month, I click run reports, and it does all that for me. But if you're going to be in business, then you have to understand the process, right, that your software is using to do all of that. And so that's what we're learning here, is all of these accounting processes, even though many of them are done by computer now. All right, a couple more concepts, and then we're done. The first is how to calculate what's called the debt ratio. Your debt ratio is your total liabilities divided by your total assets. So this helps us understand if our debt is at a risky level or if it's at an okay level, okay? So it's just comparing our liabilities to our assets. So if we had $10,000 worth of liabilities and $10,000 worth of assets, our debt ratio would be 1, right? They'd be 10,000 divided by 10,000 would be 1. So think of it in terms of if liabilities climb relative to our assets. So if liabilities were 20,000 and assets were 10,000, then our debt ratio would be 2. So generally speaking, having a higher debt ratio is considered a negative thing because it means you have more debt relative to your assets. So here's an example of it. We have Costco versus Walmart. So they give us Costco's total liabilities. I'm guessing that's in millions. When it says in millions, it means we're going to add 6 zeros to that number. Okay. If it says in thousands, we would add 3 zeros. If it said in billions, we would add 9 zeros. Okay. So Walmart, for example, has assets, not in the millions, but in the billions. Just go into one Walmart store and think about what the value of that inventory is in that store, and then multiply that by the 1,900 stores they have, and then all the warehouses, right? Anyway, so they find the debt ratio by taking the total liabilities divided by the total assets, and we can compare these And we can say, even though Walmart's a much bigger company, it would be hard to just look at the absolute dollar numbers of Walmart compared to Costco. This brings us down into a common level, and we can see that Walmart's carrying less debt relative to their assets. And that's what we use that for. Okay, that's it from a presentation standpoint. And so